December. Whoops. Sorry. 4:01, I'd like to call the December 18th meeting of the Budget Review Commission to order, and we'll start off with roll call.
Vice Chair Schweiker.
Present.
Commissioner Badenoch.
Here.
Commissioner Carla.
Here.
Commissioner Lettieri.
Here.
Commissioner Newman.
Here.
Commissioner Pullen.
Here.
Commissioner Stevens.
Here.
So at this point, we have public comment where citizens may address members of the Budget Review Commission during the public comment regarding non-agendized items and on the agenda items when the item is presented. Arizona law prohibits the commission from discussing or taking action on an item that is not on the prepared agenda. Citizens may submit one request to speak, a public comment card per meeting, to city staff. Public testimony is limited to 3 minutes per speaker. Written public comment cards can be submitted to city staff at any time for the agenda or non-agenda items. Cards submitted after the public comment has begun for the item will be provided to the commission at the conclusion of the public comment for that item. I don't think we have any comment cards, do we? Okay. First thing I'd like to do is do a new member introduction for our new commission member, Randy Pullen. Randy, you want to give us just a brief background?
Sure. How brief do you want it to be? 1 minute or 10 minutes?
I've got it down to 3 minutes.
3 minutes. I figured that's probably what it was going to be. Well, I have been in accounting and finance for about 46 years, which is probably older than some of the people in this room. So I was a partner with Deloitte & Touche. I did audits of banks and savings and loans in the late 80s when we had a collapse. I also did forensic audits of banks for the federal government. I left Deloitte in the early 90s and set up my own consulting business and did a lot of venture capital work over the years and new company setups and operations and management. And then I got involved in politics, and you know that I was the chairman of the Republican Party for 4 years, and I was also the treasurer of the Republican National Committee at the same time. So I have a lot of broad experience in finance and accounting, and so I look forward to working with you all here as we work through the budget, and I'm looking forward to learning quite a bit about the budget of Scottsdale. Thank you.
Well, thank you, Randy, and we look forward to having you with us. The next item on the agenda is the approval of the minutes of the December 8th special commission meeting. Does anybody have any comments on the minutes? Mark?
I have no comments, so I'd move that they be accepted as written.
Do we have a second? Okay. Bob seconded. Any discussion? All those in favor, please signify by saying aye.
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 Good. Motion carries. So now we're going into the financial conditions report. Sonia will do this. We've allocated 30 minutes for this, so I think she'll make her presentation. Any questions you have, hold them for the end of her presentation and then ask them. Sonia?
Thank you. Before I begin, I'd like to do a few things. First of all, I'd like to introduce a couple staff members in the audience that are here because they're the real experts and can help Scott and I answer any questions. We have Anna Hanthorn, our Assistant City Treasurer and Assistant CFO, who is actually the real expert on the city's general ledger and finances. So she's here in the audience. And we also have Michael Gugensberg, who is our sales tax guru. He's our sales tax supervisor. So he's also here in the audience if you have any specific questions. Today, our focus is on revenues, and I wanted also to walk through with you 2 handouts that we gave to you before I begin my presentation. One of the handouts is a very large 11 by 17 handout. I wanted to let you know what that is because we will be talking about items that are in this handout. So this handout shows you all the city's major revenue sources split out by fund. As you know, government accounting is done by fund. It's very unlike for-profit accounting, so we account for everything by fund. You see the general fund, airport fund, transportation fund, tourism fund, and so on and so forth. These groups of fundings and all the different revenue sources that are accounted for in each of these funds. This first page, they are called governmental activities. That's what we consider as our governmental funds. The next page, we have a group of funds and also the major sources for those funds, and we call those internal service funds. They are internal departments that serve other departments. They self-insurance healthcare fund, the fleet management and fleet replacement fund, the risk management fund, which is our self-insured workers' comp and liability and property insurance, and our PC replacement fund, and the revenue sources associated with that. And then the last grouping of funds is our business type activities, which we call enterprise funds. Those are our water sewer funds, our solid waste fund, aviation fund, and they also have capital projects funds. And so when we go through the presentation, when Scott and I go through our presentations, you'll hear that we're talking about governmental funds, business type activities or business type funds, and that's what we're referring to. Okay? So moving to the presentation, we put this presentation together to share with you some key financial metrics and trends.
Can I ask a question? I know you said wait till the end, just this one. It would have been a lot more helpful if we would have had a percent of total of the revenue by each one of these categories, not in a context the major contributors are. So it's a piece of information that would really help me understand the sources of revenue, not just description, but as a percent of total.
Thank you, Commissioner Lettieri. The percentages will be presented in Scott's presentation. So his presentation will show the percentages. We also have the second handout for you, which is the detail reports that's 20 pages long and has all the detailed revenues categorized by all the major revenue sources that you see in this summary. So you will have the line item detail and the actual dollar amounts, and when we get to Scott's presentation, which is item 4 on the agenda, he will have a pie chart showing percentages, and he will go through that with you. Great, thank you. Okay, so going back to this financial conditions presentation, we put this presentation together to share with you some key financial metrics and trends that show whether the city is financially healthy and on financially sustainable trend. You should have received the full financial condition report. It's in your packet. The report contains a lot more information than I'm able to cover today, so I encourage you guys all to read the report. As this presentation, we don't show every single metric. We just highlight the main ones. So as you're aware, government finance is very different than for-profit finance, and there are numerous studies and research over the years on how to assess government financial condition and sustainability. These studies are done by different authorities on government finance like the ICMA, the GFOA, rating agencies, and various government finance scholars. We look at these studies that are published by these authorities to help us develop the metrics that we are about to share with you. So we picked the 5 key metrics and ratios that are used to assess the city's financial health and whether we're on a sustainable path. First of all is operating results, and basically that's, are our revenues covering our expenditures? Are we operating with a surplus, or are we operating in a deficit? Are we dipping into our reserves? We know that looking at, so that is the first metric I'll show you. We call that structural balance. Basically, our ongoing revenues need to cover our ongoing expenditures, and that's one of our key tenets of how we put the budget together, making sure long-term, not just 1 year, but we look out 5 years, our ongoing revenues cover our ongoing expenditures. And we, as you know, looking at just revenues and expenses don't tell the full picture of an organization's financial health. We have to look at the balance sheet as well. So next, we look at our cash solvency, and that is looking at, do we have enough cash to pay our bills? And also, do we have enough cash reserves to respond to emergencies, unexpected events, economic downturn, etc. We then also look at our long-term obligations. That is primarily the largest obligation that we have is our debt burden, the bonds that we issue, the debt that we have, and also our pension liability. So basically, are we overburdened with debt? Do we have the capacity to issue debt in the future for capital needs? That is a very important indicator of our financial health and our financial sustainability. Next, we also look at our capital reinvestment ratio. And are we keeping up with the infrastructure replacements as they age? And finally, net position. It's similar to net equity. Is the city increasing its net position, meaning do we own more than we owe? Or is there a decreasing trend, like as our liabilities increasing more than our assets, which is not good as it might signal problems ahead? Next slide. Oh, did Carol leave? Can you go past that? Okay, so just a couple quick things. All the data that we used for the financial metrics are all obtained from our audited annual comprehensive financial reports. So we went back through years 2007, which is the beginning of the Great Recession, through 2025, our latest audited financial report, which is hot off the press. It's actually not even published on the website yet, but it's audited. The auditors are done with the audit, so we have the data, and we've included it here for you to show our trends since the Great Recession. It really helps us understand our revenue and expenditure trends and how financially sustainable and healthy we are. We also compiled peer city averages. We looked at Mesa, Gilbert, Chandler, Glendale, Peoria, and Tempe, primarily picked based on their size and location. We're not looking at Tucson. We're not looking at something outside the Phoenix metro area. We're also not looking at very small cities or very, very large cities like Phoenix. And they don't have their 2025 data available yet, so we were able to pull their 2024 data, and also it's from their audited financials. And again, our metrics are put together based on governmental activities, which is the funds that I shared with you earlier on those slides, and then business type activities, because we look at those two groupings of funds or operations very differently because of their different funding sources and their focus. Okay, next slide. So the first set of metrics on our operating results, next slide. I really want to touch on this as what happened in the last 5 years, because as you will see in the chart, this will really help explain it. In the last 5 years, with the start of the pandemic, there was an unprecedented increase in federal spending. The city received $60 million in federal stimulus dollars. And there was, with the lockdown, instead of a decline and a fall off in sales tax revenues, which is what we originally anticipated because shopping centers, shopping malls, restaurants were closed, we anticipated a fall off and a drop in our sales tax revenues. Instead of that, there was actually a surge in consumer spending because everybody was buying everything online and they all got stimulus checks as well. So we didn't anticipate that, but we actually had an increase in revenues instead of a decrease in revenues. And then with the post-pandemic demand and the post-pandemic travel, Arizona was one of the first places to be open. So we experienced a huge surge in tourists and more consumer spending. The double-digit inflation also raised prices and then, resulting in increased sales tax revenues. There was also a housing market bubble in 2022 or somewhere around there, which created a lot of capital gains tax, and that goes to the state, but it trickles down to us as increased revenues as well. We also sold 2 pieces of land and generated about $70 million in land sale proceeds. So during that 5-year period, there was a huge surge in one-time revenues. Some of it may be a new base that we might have because of inflation, but a lot of this is one-time revenues, like the stimulus money or the land sale money or the housing market capital gains. Those are not ongoing revenues. At the same time, we had an initial slowdown in expenditures in that 5-year period. The initial pandemic lockdown, we probably didn't even hire hardly any of our seasonal workers. So you'll see in 2021, we had a dip in our expenditures because we had a reduction in expenditures. Everything came to a screeching halt. We didn't move forward with construction. Some of our, there was a lot of delay in spending because of all the supply chain issues. And then we also then subsequently had significant vacancy savings with retirement, attrition, and the tight labor market where we weren't able to fill the positions. So with that, what you'll see is a gap, a revenue expenditure gap and a buildup of cash. Next slide. So here we go. So going back to 2007, which is on the far left hand side of the chart, you see that we were operating at a deficit with the Great Recession. And we were able to operate, the blue line being the expenditures, the orange line being the expenditures and the blue line being the revenues. You can see that with the Great Recession, we lost significant amounts of sales tax revenues. So we were immediately in an operating deficit position. And so we fortunately had significant buildup of reserves that we could rely on, and the city strategically planned on using those reserves down to a minimum required level. So you'll see that happening for quite a few years. And by the way, this is our governmental activities. So this includes not just the general fund, but all our restricted revenue funds as well. So we were spending down some of our restricted revenues as well, not just the general fund. There's a significant amount of restricted revenues. Then as you can see, starting in 2018, we started to climb out of that deficit position. We balanced our books. And then in 2020 was when that pandemic happened and when that split happened. Which is what I explained, which is surge in revenues. And we haven't seen the huge surge in expenditures yet because some of the expenditure increases like the personnel, wage and cost inflation, the police and fire facility or personnel and wage increases, those haven't quite shown up yet, but they will show up in 2026 and beyond. So basically, with that, what the important thing for us from a budgetary standpoint is our expenditures will show an increase because of the inflation pressures that we have, and we will probably see a slowdown and a flattening of revenues, and we just need to make sure that we can, those two lines don't cross, right? And we just need to make sure that on a long-term basis, we maintain that structural balance. We don't go back to a deficit balance, and we make sure that we have those reserves for the next economic downturn that will eventually come around. So that's the focus that we have right now from a city standpoint. Next slide. We have been very prudent in using those surplus funds. We've built up a lot of reserves. Now, keep in mind, it's not just in the general fund. There's quite a lot of reserves built up in the construction funds, in the preservation funds, so some of the restricted funds. We have been able to cash fund various capital projects. We've been able to pay down our police pension liability, unfunded liability. We've been able to increase our general fund reserves to a healthier level, and we've been able to fund the ambulance service startup. So we've been really focusing on using those surplus funds for one-time needs and not using those surplus funds for ongoing expenditures. And we will continue to be prudent in using those surplus funds. Our challenge to put the budget, when we are putting the budget together, is, as I said, maintaining that structural balance when operating expenditures are increasing. And as I talked about, wage and cost inflation pressures, street overlay needs, and whatever else, we do have a lot of times more needs than we have expenditures to fund. So we just have to be very mindful and prudent in making sure we are strategic and plan well and and focus on that structural balance. Next slide. So now we're moving on to business type activities. This is our water, sewer, solid waste, and aviation funds. As you can see, for those funds, we pretty much operate from a cost recovery standpoint. And so there's really not a huge surplus. They're not impacted by sales tax revenues because they're not funded by sales tax revenues. If you go to your cheat sheet here, they're primarily funded by rates and fees and charges. And so you can see that they are pretty much, the revenues and expenditures pretty much are aligned. Any excess revenues are used for capital and or pay down of debt principal. And that little split at the very end in 2024 and 2025, we did raise our rates in 24 and 25 in anticipation for the infrastructure needs that we will have and new debt issuances that we are anticipating. And that little dip in 2025, that's because we had a change in estimate for one of our joint ventures. And with that change in estimate, there was an accounting entry that reduced the expenditures by $15 million. It is a one-time thing. It is not a budget thing. It is not a cash flow thing. It is an accounting estimate that we changed. So that was what that was. And so really in 2026, that will go back up. Okay, so that concludes the operating results. Let's move on to the cash, our liquidity and our cash solvency. Liquidity is a really important indicator of financial health. If our trend, this is our cash, our available cash, it basically tells us, are we able to pay our bills? Do we have enough cash to respond to unexpected emergencies, economic downturns, as we saw in 2007, how much we relied on our reserves to carry us through those years of economic downturn and revenue losses. So this is unlike a for-profit. Sometimes for-profits look at liquidity, basically cash and investments divided by current liabilities is a 1-to-1 ratio, is sufficient for a business, but it is not sufficient in government because we're having to reserve money for a rainy day, and our rainy days could be very sizable depending on what the natural disaster or emergency that we have to, and the economic downturn that we have to attend to. And then every time we have an economic downturn when revenues drop, because the services and the expenditures we have are people and core services, we can't just slash everything overnight. Like some businesses can stop producing, production or shut down something. We can't really do that. We have to continue services and find a way to realign revenue and expenditures over time. So we do rely on those reserves to give us that time to realign in an economic downturn. So wanted to talk about in 2025, that spike. So the orange line is our business type activities. That's our water, sewer, solid waste, and aviation. The reason for that spike is because we issued water and sewer debt at the end of 2025, and we haven't spent anything down yet. So this cash and investment includes our restricted cash and investments. It includes all the restricted cash as well. And likewise, with the 2025 on the governmental activities, it went up to 4.4 because we also issued the next tranche of our bond 2019 debt at the end of 2025. So that spiked the cash and investments up. Okay, next slide. So the considerations that we have for our cash reserves and liquidity as we put the budget together is having enough and adequate cash and liquidity. And as I mentioned, unexpected emergencies and disasters, economic downturns, but we also are self-insured. We're self-insured for workers' comp. We do carry, insurance above the self-insurance limit. But we are self-insured for health and dental. We are self-insured for workers' comp and liability, so we do have to have adequate reserves for those self-insurance programs. We do have to have adequate reserves for capital asset replacements as they come due. So because of the large capital assets that we have, roads, sewer, water, we have to plan for that and make sure we have enough cash. We can't just raise all the cash we need for next year in 1 year. So it's something that we have to continue to plan for and strategize for. We also have to maintain our AAA bond rating. We're very proud of our AAA bond rating because it allows us to issue debt at lower cost, and debt is a really expensive, it increases the cost of our infrastructure. So anything that can help us reduce the interest cost and reduce our financing costs helps us reduce the overall cost of our infrastructure. No different than your credit score getting a mortgage, basically. Okay, next slide. So now that we've looked at our cash position, the next thing is our debt position. Are we oversaddled with debt? How does that look like? Again, from a financial sustainability standpoint, we don't want to see this trend line increasing where it basically handcuffs us to paying debt. So as you can see, we look at this debt, principal and interest payment, plus our required pension contributions. This doesn't include our one-time extra contributions. This is just our required contributions that's calculated by our actuaries. So our debt, principal, and interest plus our required contribution as a percent of revenues. Basically, what we're looking at is the higher the percent, the less is available for operations, and the more is tied up in debt. And so if this trend is increasing, it could signal challenges downstream, especially if that's an economic downturn and we lose revenues, then now all of a sudden this percent becomes higher and higher. The reason this percent has gone down is, number one, we've been able to fund capital projects with cash over the last 5 years instead of issuing more debt. We've also had a lot more revenues, so the percent, because the denominator is higher, the percent is lower, and we've also been paying down our debt. In the previous, from 2007 to 2014, we were still issuing the preserved debt. So we were still issuing quite a bit of the preserved debt. So that's why that percent was climbing. And now we've been paying down that preserved debt, and then we haven't issued any new debt, and we've had a lot of revenue increase, so that percent is down. S&P tracks, all the rating agencies track this percent closely as part of an indicator of our financial health. As you can see, I put that on the side. We are not scored high for this. They consider a AAA scoring for this ratio to be 8% or less. So we are scored between a AA- and an A+ based on our percent. We do have some additional debt that we will be issuing on the governmental funds, which is really our Bond 2019 debt, but that will be funded by property taxes. And so we're not concerned with this. Our peer cities average is about 15%. I think our target is, if we stay within 14 to 20%, we're still feeling financially strong and sustainable. Basically, it's not hamstringing our operations. Okay, next slide. I'm gonna have to speed up real quickly because I think we're, next one is on the business type activities. We do not have significant debt in aviation. I think there's a very minimal amount of debt in our airport fund, and we don't really have any debt aside from an interfund loan on the solid waste side. So primarily the debt on our enterprise funds is water sewer debt because of the large infrastructure that we carry there. And so again, we look at debt coverage, and that is the net operating revenues minus the expenditures, what we have left over for capital assets and debt service. We look at that, excluding depreciation, as a percent of our debt, principal, and interest. And obviously, the higher the better, that we want to make sure we are able to cover at least 2 times our debt expense. Our revenues net covers at least 2 times our debt. And that's our policy, and we have been more or less around that policy. It spiked, again, because we paid off some debt, we issued the new debt, and the new debt service hasn't started yet. So once the new debt service starts and we issue the additional debt in next year and the next few years for the capital that we have, that 4.55 will come down. Also, the 4.55 is because of that 15.4 million gap entry that we did that lowered the sewer expense by 15 million. So we ignore that 15 million gap expense, it's actually 3-point-something%. So if that makes any sense at all, that was a gap entry. And so that 3-point-something% coverage is expected to go back down below 3%, but not below 2% as we issue more debt and as we start paying on that 2025 debt. All good? Okay, next slide. And then the next slide is the pension funded status. We are dedicated to ensuring that our pensions are healthy. As you have heard in the past, when state and local governments do not pay attention to pensions, it becomes a problem for them down the road. And back in 2015 was when the GASB, the government accounting standards, mandated that governments start recognizing pensions as a liability because it was becoming such a big problem. And so you can see that in the orange line, the top line is our Scottsdale Fire funded status for their PSPRS, which is the Public Safety Personnel Retirement System. It was funded, actually overfunded in those previous years, but deceptively so. That was because PSPRS had a lot of problems. They had outdated actuarial tables, they had outdated actuarial assumptions and other problems that artificially inflated the funded status. So when they went through and did their reform and fixed all their the problems and the provisions with their plan, fixed the actuarial calculations, that's what caused the fall in the funded status, and that's what caused the significant unfunded liability that had to be recorded. So in 2015, the city recognized over 200 million, 200, I don't remember, 50 or 70 million in unfunded liability, which then grew to 400 and something million by 2022 or something like that. And that was when we started paying down that pension unfunded liability because it was getting out of hand. So that's when you see the blue line at the bottom is the police. So the police, same thing happened with police and fire, same PSPRS plan, that fell down to a 52% in 2015. And so in 2022, we started paying that extra pension liability. And as you are aware, last year we council authorized and, with the Commission's blessings, we brought forward to council 50 million. And that is not reflected in this yet because that is something we're doing this fiscal year. So it will show up in the next actuarial report. We're paying that 50 million on a quarterly basis. So as of today, we've made 2 quarter payments. So we've paid half of that and we will pay the other half in the next 2 quarters.
Just a clarification.
Yes.
What would those percentages be with that, since you're putting it in this year?
Yes, thank you for that question. So we did receive the latest actuarial report for 2025, and with a 50 million contribution, that let me look that up. They provide the projections for us. So the actuaries actually provide that projections for us. With the 50 million, that 72% is expected, all else held equal, is projected to go to 83.6%.
Yeah, the point is it puts a dent in the numbers.
Yes.
It does.
Yeah, it brings us up to where we would like to be. So again, rating agencies also pay very close attention to this. S&P, for instance, considers an 80 to 90% as above average. So that's kind of our target right now. And we will also pay attention to the fire as well because we don't want that to drop below 80%. So we will probably consider some, additional contributions through the budget process and make sure that those are maintained at the 80, 90% level. Okay, next slide. So I'm almost done. Capital asset reinvestment. So this is another ratio that our rating agencies look at, and also another ratio that these authoritative guidances have us focusing on is our capital asset reinvestment. Partly because cities and governments, we invest citizens' tax dollars in significant infrastructure, roads and facilities, public safety facilities, and water and sewer infrastructure. So our capital asset reinvestment is protecting those investments, reinvesting in them, and making sure that we are not, we're maintaining those assets. It's very, very important. According to Moody's, so this ratio, what this ratio shows is it looks at the accumulated depreciation as a percent of the original cost of the asset. And the idea is that you should be at least reinvesting as much as your accumulated depreciation. And if you're not, then your percent is going to creep up. And according to Moody's, a ratio of 65% or more may indicate that we are lagging behind in our reinvestment, lagging behind depreciation, and it may signal that we need to issue debt to do some capital assets. And so you can see that for the business type activities, again, is primarily water and sewer. We're nowhere near 65%, but that trend is increasing. So that signals to us that we do have to pay attention to water, sewer, aging infrastructure. And then on the governmental side, we are creeping up, and that's the public safety, public facilities, streets, and any other parks, infrastructure that we have. So how have we addressed that through the budget? Next slide. This is my last slide. This is how we've been addressing our aging infrastructure and investment in aging infrastructure. So for public safety facilities, we do rely on the general fund and any voter-approved bonds. So we did have Bond 2019 addressing our aging police and fire training facilities and some of our aging fire and police facilities. And Parks and Rec, we did get voter approval for that 0.15 park and preserve sales tax, and that will assist us in funding asset replacements for those park and recreation facilities. Bond 2019 also provided some funding like the irrigation for Vista del Camino and Cactus Pool, and there were some facilities in Bond 2019, and we do rely on the general fund as well. Transportation, we have the 0.2% sales tax that we use for street overlay, and we also have the 0.1% arterial life cycle transportation sales tax for that, and then general fund. And water and sewer infrastructure is 100% funded by water sewer fees, and other public infrastructure, same thing. The Bond 2019 addressed some of those, and general fund, and if there's any other funding sources that we might have. That is my last slide. I can take any questions if you have it.
I'm going to withdraw all my questions in the interest of time and make 3 observations. One of the things I'd like you all to know is this is the report that she's referring to that the slides came from. From everything I can tell, what I understand, this report was not gamed. It was a self-assessment that was done by the staff using metrics that are generally believed to be appropriate metrics for state and local governments. And the tables that are in here and the descriptions are a pretty good self-assessment overall. I think it makes the city look pretty darn good. The second observation I was going to make is the slide 17 on accumulated depreciation. Another way to look at that, 20 years ago, assets were 40% depreciated, now they're 60. So if you assumed assets last for 10 years, 20 years ago, our assets were only 4 years old. Now they're 6 years old. So it kind of is a mega picture that we could have some potential problems with an aging infrastructure, but that's super high level. So you'd have to get into the details to really know anything there. And then the final thing I want to mention, I will want us to kind of look at the police pension thing again to see if there's a financial opportunity to do some extra funding once we have our head around the reserves and where we stand. This will be a spring discussion. And the only other thing that came out of the police thing for me is I'm pretty sure, I believe we want to be in the top 3 as the way we compensate our police policemen. And I believe there are more than 3 cities that believe they should be in the top 3. And that sure sounds like a recipe for potential disaster. So it's probably not our job to look into that. I guess as a Budget Review Commission, we'll see what that's going to do to salaries. And maybe we separately ought to just talk to our, well, I guess if city manager, I don't need a comment from you now. It's just an observation of something that scares me. Maybe at some point that's worth addressing whether that's the right way to be looking at things for a city. And that's all.
Thank you, Mark. Good observation. Brad?
Yeah, thank you, City Treasurer Andrews. A very, very good report. It actually captures the spirit of what I was asking about it 2 meetings ago. I couldn't be at the last meeting, but I think it does a nice job of capturing the spirit of what I was talking about. And I like a lot of the metrics in here. One metric I was thinking about here in terms of your ongoing revenues versus ongoing expenses, I talked about a leverage balance sheet. And where revenues are always staying ahead of our known expenses. And so if we come up with a metric that kind of maybe that's 1.05x of, if the revenues versus expenses that we know are ongoing just to run the city, it seems like that would capture kind of where we are on a quarterly basis when we get to the quarterly report. That would capture how are we doing tracking on revenues versus expenses on an ongoing basis. I think that becomes part of a KPI package there. But I think it captures, it points in the direction of kind of what we didn't have all this information last year, but we were able to get some of the priorities, like maintaining the maintenance was more important than new capital, because we also know that we've got a lot of capital projects, but only a certain amount of bandwidth. So you said more debt would change that one metric. I'm not sure more debt's going to help that if you don't have the bandwidth to get the project done. So City Manager Caton may have some comments on that, and I know he's been working on that, but it seems to me like it's more bandwidth to get those projects done there in terms of capital renewal would be important there. And I would say it's also prioritization of projects, because there are certain critical projects. I went through the whole budget and I gave it to each of you last year, and all of our bandwidth was eaten up by just critical projects, let alone preserves and all the other things that could wait. Don't panic, Carla. I'm not going to say they're waiting, but I'm just saying, because those are dedicated funds, but there's a certain amount. You can't do all of that right now at the expense of critical projects, especially if you're going to start getting traction on renewal of roads and renewal of water and things, the really large capital projects. So I would just say that really ought to come through clear in our budgeting this year in terms of priority. And then I'm glad to see that the pension kind of gets solved by what was done. I didn't realize the leverage that $50 million would do, but if we even have room to push that further, as Mark said, I think that would kind of solve that problem. The police and fire are happy, and so when I have a problem, then they show up because they're happy with us, all of that. And then the last item was, I think that covers all my comments on that. So I think it was very good. It was very informative, very helpful.
Thank you, Brad. Skylar?
You guys hear me okay? You guys can hear me?
Yes, we can.
Great. Yeah, no, I would echo what everybody said. Thank you so much. And my main takeaway is really, city's financially strong today, and that was a great report. Really makes clear that, I think discipline, maybe not expansion, is what's going to protect the strength of the city budget, and especially I think what was laid out as revenues normalize and costs rise. My question is more clarifying, and as it relates to the operating results. Has the city looked at how much of the recent operating surplus is going to would remain if we excluded those things like the federal stimulus and the land sales and the interest earnings?
Commissioner Bagnall, do you mean removing those from the last 5 years and see if we were operating in a surplus position?
That's right.
Yeah, so without doing the math in my head, I would say yes, because sales tax was a significant factor in that revenues. Sales tax increase was a significant factor, and also state shared revenues was a significant factor in those increased revenues. So even if we stripped out the one-time federal stimulus and the land sales, we would still be in a surplus position.
We're still green there. Thank you.
Let me just add one more thing. So why don't you share with everyone your position on how you use one-time revenue sources? Because I'm pretty sure you don't ever use one-time revenue sources for ongoing expenditures.
So the way we look at one-time revenue sources is what we accumulated in fund balance last year. And then when we look at our 5-year, I don't know if I'm answering your question, so help me out here. We look at our 5-year and we make sure when we put our budget together, our revenue projections and our expenditure projections do not result in a deficit, and that the one-time expenditures that we're using is the excess that we accumulated from prior years. So we're drawing down fund balance for one-time needs, not for ongoing. Did I answer that question?
If I may just add, we would never use one-time revenue to support ongoing expenses.
Brad?
I have one other comment regarding revenues. You know, we had a lot of discussion in honor of David Smith about the food tax last year. And of course, the state, I believe, has a law now, and various municipalities are implementing that. In calculating revenues for this budget cycle, should we just assume that the food tax goes away, even though the council still has to decide that? But should we just assume that in our budgeting? Because it seems like it's inevitable that that's going to happen. And if I understand the numbers, it's somewhere around $15 million a year. So it's digestible. It feels like it's digestible in the numbers here, but if I'm wrong on that, please correct me.
City Attorney, I believe you have a comment?
Yeah, I do. I don't think the food tax is ever going to go away. Reason is that there are many small communities in Arizona that 90% of their revenue is from the food tax. I think what the legislature did is they require a vote of the local voters to increase the food tax or what have you. Now, our city council could obviously get rid of it if they choose, but I think it's very unlikely at the state level it's actually going to go away.
Well, thank you. Is it fair, though, that if I look at the metrics and the numbers, it feels like there's room in that? Is that guidance that we could think about? I mean, if there's a place where we could appropriately tax, it seems like that would be a place in that. And obviously, there a lot of other machinery has to go into motion to make that happen. But from a budgeting standpoint, it seems like we've done a good enough job to be able to manage that. It's just a question. And if I'm off on that, please correct me.
So help me understand what you mean by appropriately taxed, like from a budget standpoint, like.
Well, if there's a thought out there that certain taxes, I'm thinking, talking with Commissioner Smith when he was on the commission, in terms of that being a regressive tax, okay? Is it, if there's room in our budgeting, the way we've done that, are there, anytime we can take taxes away, I think we should try and look at that.
Oh, I see.
Yeah. And there are other places that we should look at that if that's possible, but I'm not going to get into a big food fight over over taxes right now. But I mean, we should look at that if we're bringing in enough revenues to cover what we need, and we're in good financial health, which you've done a great job of. Why do we want to tax more or continue to tax?
I think you will see that in the budget, specifically, like, for example, last year, the example would be in the preserve, the 2004 1.15 preserve tax. We do propose paying off the remaining debt and potentially sunsetting that debt early. So we did propose that in the budget. So if we do project out that we don't need certain revenues and fees, I think that the city in a responsible manner would suggest that. But given our expenditure projections and what we know about expenditures, we don't see that opportunity right now.
Okay, I understand that. And I understand there's other debt that we could pay down. So maybe that's the focus, is between now and pick a year, 2030. Our goal is to get those things taken care of, and then you can start to think about that. That's fine. To me, I'm thinking strategically in terms of where we're headed with this, rather than just thinking up new things to do. What are the core things we need to do? Has that all paid off? If we funded it, is the debt down? And try to pay as we go as much as possible. And then after that, you say, do we really need all that tax?
That is correct. So I believe, to help kind of put more perspective in this, we still believe that we have a little bit of a bubble that will kind of correct and come down. So we do believe that our revenues might flatten out as our expenditures catch up. So we don't feel that moving forward is going to be this big gap.
Mr. Chair, if I may, I just add to this discussion, and it's a it deserves a complex answer to your question, and so at the risk of oversimplifying, I might submit that in a number of areas, in critical infrastructure, we have been deficient in our discipline in funding those. And so one example is in our roads. And so I appreciate the question, and the short answer would be yes, but I don't believe we're in that financial situation. I believe we have deferred some critical infrastructure needs for maintaining significant roads, and that will take at least 5 years of significant investment to get us back what I would believe would be an acceptable community standard. So that's just one example where I believe there might have been some support for projects for nice-to-haves, what some people would consider nice-to-haves, and we have potentially deferred the needs. And now we are in that situation in utilizing the roads as an example. If you don't have the discipline to fund it at the level that you should, which is the situation that we're in, it takes additional funding to actually get us back to the level. So more detail on that in the future, but I appreciate the question. And then also I might just quickly submit that we're seeing significant wage growth as referenced by the comment about the public safety. It was police was referenced, but it's the resolution for the third in the 3 area is first responders for fire and police. So about 800 sworn that have had significant wage pressures upwards. And so on an operating expenditure account or operating side, that is something we will be grappling with.
Yeah. No, I appreciate the perspective. It helps put my thinking in perspective because I agree completely with let's get all those priorities done before you start thinking about rearranging the revenue stream in any way on that. But at some point in the future, it's a nice lofty goal to have at some point here. But you know, we don't know what next year with the economy and everything's going to hold either. So
I agree with you on that. We don't know what the legislature is going to take away next. Carla? And I think that'll be our last comment on this one, and then we'll move on to the next segment.
Okay, thank you. First off, I want to thank staff for an excellent report that makes everything really easy to understand as much as it can be. While I understand what Brad's talking about, I don't think we give up any revenue stream, because what really jumped out at me from all of this is pretty much what Greg said about the aging infrastructure. That's deficit. I mean, we have an issue there. And then also if we can pay more on PSPRS. And then just final quick comment on the preserve. There are unfinanced preserve commitments that we made to the voters. And as that comes forward, I know that staff will look at where we are on a regular basis, but I would not count on sunsetting the tax anytime soon. Thank you.
Thank you, Carla. Okay, if there's no more questions, I think we'll go on to the next segment, the historical revenue trends, with Scott Sellen, our budget director.
Good evening. We're going to take a look at historical trends of our major tax revenues, tax revenue sources. The presentation we're going to look at focuses on the major taxes, but you do also have all the fees and charges down to line item detail in one of the packets in front of you. And once we get through this, we can take a look at some of the fees and charges in that handout, time allowing. Could we go to the next slide? These are the individual items we'll take a look at today. We'll take a look at sales tax. I would mention, as Sonia did, that we do have our resident sales tax expert here that could provide some additional insight if there are technical questions. We'll take a look at state shared revenues, primary property tax, and transient occupancy tax, or the bed tax. Next slide. This pie chart shows our operating revenues for the FY 25-26 budget year. This presentation that I'm doing right now focuses mainly on the dark blue, orange, and green wedges of the pie, the sales tax, state shared revenue, and property taxes. Although, like I mentioned, we can get to fees and charges at the end. This encompasses all city funds for a total of just over $1.1 billion. Next slide. Next, yeah, thank you. So talking about sales tax, we've showed versions of this chart in the past. We do it to reinforce that of the total sales tax that you pay in Scottsdale in a given transaction, only 1.7% of that sales tax is due to Scottsdale's local sales tax. The majority of sales tax goes to the state, and the county also charges some sales tax as well. Our overall sales tax rate of 1.7% is made up of 6 components that are listed on the right-hand side of the slide here. The largest component is our 1% general fund sales tax, which does not have an expiration date. And the rest of the sales tax components are restricted for specific use as listed. For example, the 0.1% public safety sales tax, which also does not have an expiration date, and the 0.2% transportation, also no expiration date, that goes into our transportation fund and is restricted for use on roads and streets. And then the final 3 components with their expiration dates listed. Our future sales tax slides are going to focus on the 1% general fund, but it is important to remember that each of these smaller components of our overall sales tax rate will follow similar trends. Can we go to the next slide? This chart shows the adopted budget for the 1% general fund sales tax in red, that's the red line, and compares it to the actuals for that particular fiscal year in yellow. Going back to fiscal year 2010 in this case for the 1% sales tax, or back to the Great Recession era. Some of you may have seen this chart before or a version of it. We start in fiscal year 2010 at about $83 million a year. And looking at the actuals line, the yellow line, pretty consistent growth throughout the 2010s with a little deviation here and there. Until we get to the pandemic era. During that era, the revenues increased significantly when compared to our budget. You see kind of the deviation between the red and the yellow. As Sonia alluded to earlier, we kind of projected that sales tax might dip after we saw the pandemic start to take hold, and then in actuality, the revenues kind of skyrocketed. I don't think many people anticipated the amount of online shopping that would occur during the pandemic. And as Sonia mentioned, this was also fueled by the federal stimulus that was provided. It shows the difficulty of projecting. The actuals show a bubble when compared to the budget, and we've been anticipating a correction for several years now. We've been anticipating a correction. Could we go forward? Maybe one more. So we've added the year-over-year growth in the actuals on the yellow line. We started with kind of the biggest year of pandemic growth where the actuals increased year over year 11%, and then 21%, and then another almost 10% after that. And we started to see a little bit of a pullback. It was slower growth in 2025 when compared to the recent history and general historical trend. And then our FY26 projection reflected an overall decrease, mostly due to the state's elimination of the residential rental tax. And then in the out years beyond the dotted white line in the adopted budget, we're projecting a gradual return to more average growth in the out years, 3%, and then that increases to 3.5, and then to 4. Could you go forward one? So in the white box that just appeared, you see that the year-to-date trend, the current fiscal year through October, is that the 1% general fund is $4 million and 8% higher than budget. That's the current state of the 1% sales tax through October. And we should have November numbers ready here fairly soon. Can we go to the next slide? Yeah, one more click forward. Thank you. So this slide stacks Scottsdale's year-over-year percentage growth of the 1% sales tax with Arizona's. Scottsdale is in yellow, and Arizona's is in the dotted grayish line. The purpose of this slide is to show that we've historically tracked fairly closely to the overall Arizona trend when it comes to year-over-year change. But you'd see that our valleys are maybe a little bit higher and our lows are just a little bit lower. So we kind of have deviated a little bit more on the extremes than the state has. Just to pick an example, if you look at FY 2009, our percentage change is at the bottom underneath Arizona's during the depths of the Great Recession. And then fiscal year 2022, you kind of see the opposite, where we were at 21% year over year, and the state was slightly lower at 16%. I'd point out we did see a fairly significant decrease in fiscal year 2024, a decline of about 3.3%. And a reason for that is that we had hosted the Super Bowl the previous year. So a lot of that spending that happened in the previous year was not happening in 2024. And the 2026 decrease that we're showing is due to the elimination of the residential rental tax, as I mentioned earlier. The state does not charge a residential rental tax, so you won't see that decrease in the state's line. You'll just see it in our line in yellow. Can we go to the next slide? And when it comes to building our projections for revenue, we look closely at the recent data. This slide takes our 1% monthly sales tax and takes a 12-month rolling average, a month by month, starting with October of 2023 and going up to October of 2025, a couple months ago. So apart from a few minor blips, the annual growth over this period is about 2.5%. There's a little bit of growth, but not that much. The annualized is 2.5%. We're going to continue monitoring the returns over the next few months to refine the general revenue picture and get our projections in line. Could we go to the next one? Yeah, and that states that our average annualized increase is 2.5%. Next slide. But when we project, we don't just look at the big picture. We get down to the individual category level. We have individual categories of sales tax that we track, and this chart shows the 12-month rolling average of each of the individual categories, the change from October 23 to October of 2025. So just to take a second to go over this. So some of the categories show fairly significant growth, like we look at our automotive category, which is the first of the red bars, showed an increase of about 100,000. Construction, which is the next one, an increase of about 200,000 over this 2-year period. Miscellaneous retail and other taxable also showed increases of about 200,000 in their 12-month rolling average. We've got several categories that are pretty much showing no growth. Our food stores, hotel, motel, major department stores, and our restaurants. And then rental, again, is showing a fairly significant decline, which we have been expecting. Can we go to the next slide? So just some risks that could affect our sales tax collections. The impact of tariffs on prices and consumer spending, it's kind of an unknown how exactly that's all going to shake out. Commissioner Newman, I believe, mentioned legislative risks. There's possibility that the legislature may take action that would impact one of our revenue sources. We've got national, state, and local economic factors that could present some kind of risk to our sales tax collections. And then finally, large one-time audit payments that we do not currently budget for present some upside risk to our sales tax projection. We currently don't project large one-time payments. Those just kind of come in, and we haven't currently incorporated them into our projections. Can we go to the next slide? That completes our sales tax discussion. We're going to go to state shared revenues for income tax. This is also called urban revenue sharing. So how it works is 18% of the state's income tax collections is distributed to Arizona cities and towns, and it's based on the city and town's percentage share of the overall population. Now, there is a 2-year lag between state collection of sales tax and when that sales tax is distributed to the cities and towns. So, for example, sales tax collected in fiscal year 2023 is then distributed to the to the cities and towns in 2025. So the good thing behind that is that it's rather predictable. We kind of know what to expect in a given year because it's based on collections from 2 years ago. I just provided a little bit of information since the income tax, the urban revenue sharing is distributed based on population. We make assumptions about growth rates. We assume 1% annual growth in Scottsdale's population and 1.7 annual growth in Arizona's population. The overall result of that is that Scottsdale's share of the pie, so to speak, would get gradually smaller over time, but the overall size of the pie grows significantly enough to ensure that our piece is always, that our raw dollars is bigger typically. So we may be losing ground, but the pie grows enough to so that our urban revenue sharing is not decreasing, I guess is what I'm trying to say. One thing to be aware of is that when a new city or town incorporates, they become eligible for state shared revenues, and this happened this past year with Santan Valley, which created a new town of about 100,000 people that are going to be factored into the calculation starting in 26-27. Could we go to the next slide? So this is a similar chart for state shared income tax that we looked at for sales tax. We have our adopted budget in red and then our actuals in yellow. They track fairly closely because, again, it's fairly predictable what we're going to get because it's based on collections from 2 years ago. I have included numbers for a few actuals. I just want to point out a few things that happened. In fiscal year 22, that decrease that happened there, during the COVID pandemic, the deadline to file taxes was delayed to July of 2020, which pushed those income taxes out of fiscal year 20 and into fiscal year 21. So the fiscal year 22 urban revenue sharing fell as a result, and then it kind of rebounded the next year. In 2024, we saw a fairly big spike. There's a couple of factors there. Just overall strong performance. There were significant capital gains that occurred. And then also an Arizona resident apparently won the Powerball, won almost $500 million. So that was listed as a factor. We saw revenues decline in fiscal year 2025 as the statewide flat tax came into effect. And we do anticipate a further decline in FY26. Could we get one click forward? So year to date, the state shared income tax or urban revenue sharing is about $500,000 and 3% higher than budget. The final calculation for this happened after we had generated our projections. So it's off slightly, but still fairly close. Next slide. So just a few risks to the state shared income tax. Conformity to the One Big Beautiful Bill Act, or ABBA. I just want to take a second to talk about this. Conformity is kind of a wild card out there. There were significant changes made to the federal tax code in the ABBA. Arizona often chooses to conform with those types of changes and has typically conformed in the past. The State Joint Legislative Budget Committee, or JLBC, they estimate that conforming to all of the changes would result in a revenue loss statewide of $440 million starting in fiscal year 26. If they did full conformity, that would reduce our projections for state shared income tax by about $3 million starting in fiscal year 28. So that's something we're monitoring. We imagine that we'll know, at least we hope we'll know, fairly early in the legislative session what they're going to do about conformity. We have population growth risk. If the state grows at a different pace than Scottsdale, if our assumptions end up being off, we could see our share of the pie get larger or smaller, depending on what happens. And then, of course, the national and state economic factors as they relate to income tax. State shared sales tax, very brief description of how this works. A percentage of every individual sales tax classification at the state level has a designated percentage, and that percentage goes into what's called the distribution base. And then 25% of that distribution base goes to cities and towns based on the population share, so similar to state shared income tax. And we make the same population assumptions for this one as we do for income tax. Again, we have budget in red and actuals in yellow. They follow fairly closely. They were kind of humming along from fiscal year 13 up until the pandemic. They were increasing at about 5.8% on average. And then you see a similar, I guess, bubble to what happened with the local sales tax, where we kind of anticipated the state shared sales tax would fall a little bit as well, and it didn't end up doing that. It ended up increasing over those years. So now we're more or less back on trend in the last couple of years. And so far through October, that's 4 months of the fiscal year, we're about $600,000 and 5% higher than the budget. Could we go to the next? And then just similar risks, population growth risk, and then economic factors that would threaten sales tax collections. And then I guess economic factors are so important, I listed them twice. So just things to pay attention to. State shared revenues for auto in lieu. What this is when you register your vehicles, about 20% of those revenues collected by ADOT for the motor vehicle registration are distributed to cities and towns. The formula for this one is a little bit different than the ones we've talked about just recently. What this one does is it considers the county of registration, and the 20% is allocated to the counties based on the county of registration, and then each city's share of that county's population is how the money is distributed. So for that reason, the Santan Valley Incorporation doesn't really impact our revenues for this particular revenue source. Could we go to the next? Thank you. So going back to fiscal 13, we started about $7 million a year. Actuals went along at an average increase of about 5 to 6% a year. And then when we got to fiscal year 22, we saw 2 years of decreases in the actuals on the yellow line. So you kind of saw the divergence in fiscal year 21, and then we saw a couple of years of decreases, followed by one increase in fiscal year 24. So when we were doing projections for this last year, we had saw the 2 years of decreases and then 1 year of increase. We wondered if maybe there was a new base. And so we projected 1% into the future, which you see on the other side of the dotted white line. When fiscal year 25 ended, we ended up about $1 million higher than our projection. And you can see that, can we go forward one click? You can see that through October, we're about 10% higher, or $400,000 higher than projections. So maybe we don't have a new base at this point. Maybe we need to, and we'll take a look as the data comes in and we'll adjust our projections accordingly. That's auto in lieu, state shared revenues for auto in lieu. Can we go to the next one? Yeah, I'm sorry. That's just the adopted budget forecast on the right-hand side. Next slide. This is our last state shared revenue, a HERF, or Highway User Revenue Fund. This is predominantly funded by a statewide tax on gasoline, 18 cents per gallon. And then of that revenue, 27.5% of those HERF revenues are distributed to cities and towns on a monthly basis. So half of that is based on relative population, and then the other half considers county of origin. So for the 50% based on relative population, Santan's incorporation would affect us, and then for the second 50%, it would not. And HERF revenues are deposited into the transportation fund, not the general fund, and therefore they are restricted for street use. Budget and actual, going back to fiscal year 2013, adopted budget in red, actuals in yellow. When we look at HERF, we see growth of about 4.1% going back to fiscal year 2013, but we see that growth start to tail off a little bit starting in fiscal year 2020. Going from fiscal year 2020, that growth rate was about 2% from 2020 until today. That makes sense to an extent with the growth maybe in EVs and more fuel-efficient vehicles. And through October, the revenues are pretty much right on target. So maybe where this slower annual growth rate is, maybe this is the new base. Of course, we'll keep monitoring it. Primary property tax, we've shown this in the past. This shows the distribution of primary property taxes based on the average property tax rates in Scottsdale. Overall, the rates may change from place to place depending on the special districts in your area where you might live or pay property tax on, and the school districts and whatnot. On average, 8% of the overall property taxes is due to the primary property tax, and 7% is due to the secondary property tax, which goes toward debt service. Can we go to the next? Budget and actual, back to 2013, tracking fairly closely. The average annual percentage growth is 2.4% since fiscal year 2013, and that's pretty much what we projected into the out years. Could you click forward? I think those data labels will show up. Yeah, so we were projecting increases of 3%, 3.1, 3%, 3%, 3% into the out years. I want to talk for a second about the large decline in fiscal year 25, the yellow line taking a dive there, due to the refunds that were issued as a result of the Quagmire lawsuit, which I believe all of you, we've talked about in Budget Review Commission meetings last year. We're not going to consider this dip in our future projections. We consider that to be a one-time occurrence that we will not plan on in future years. Through October, the property tax revenue has started to come in. It's a little bit below budget, but it is still too early to make any big picture statements about the state of property tax, primary property tax, I should say. Could we click? Let's see. Yeah, one more. Yep. Yeah, we're about $900,000. It says, yeah, $900,000 and 13% lower than budget. We'll keep an eye on it. Okay, next slide. So this is the last tax revenue source we're going to look at in this presentation, and that's transient occupancy tax or bed tax. Now, not to sound like a broken record, but starting in 2013, things were kind of humming along fairly drama-free at about 8% per year on average. So it started at just under $15 million in 2013. Until the COVID pandemic toward the tail end of fiscal year 2020, we did adjust our projections downward in 2021, and you did see the actuals go down in 2021 a bit, although our projections were still a little bit below the actuals. But then as things opened up a little bit more, people traveled more, and we see another similar bubble where the actuals, the growth was abnormal, and we've started to see that correct itself a little bit in fiscal years 23, 24, 25. We had a decline in fiscal year 2024. We stayed pretty flat in 2025. And then our projection in 2026, the current year, was a decrease down to $33 million from 35 in fiscal year 25. And we're 18% below so far budget to actual through October. That number, I mean, is a bit concerning. I would offer a caveat and say that we're now entering into the super season, and we're going to be closely monitoring those trends to see what's going on. And can we get one more click? Yeah, that just shows, yeah, 1.4 million and 18% lower than budget. So that brings me to the end of the tax historical revenues. We'll be happy to entertain any questions you might have. Oh, please.
Can I just make a comment? I think.
Sure.
I think Scott actually said this, but I wanted to make it clear that the projections that you see for fiscal year 27 through fiscal year 30 are our last year's projections. They're not our new projections for the budget. We're still working on those numbers. We won't have those numbers finalized yet, but the message is we don't think there's a whole lot of change. We might tweak it a little bit, but it's probably going to look very similar than what we had last year. Thanks.
Commissioner Carla?
Yeah, just a question. It's been all over the paper the past week that Scottsdale's growth rate is flat, which personally I'm not sure is a bad thing, but how does that affect this? Or is it, if it stays flat, I mean, is there going to be an issue, or how does it play into this?
Commissioner Carla, are you asking about the population staying flat?
Yeah, that's what the articles have been about, is that it's flat.
It's a flat population.
For Scottsdale.
Well, that would certainly present impact directly on our state shared revenues that are distributed based on population. So if we are truly flat, our assumptions were that we would grow at 1%. So if the new population numbers show us at flat and maybe Arizona's population grew maybe at 2%, we would lose, our piece of the pie would decrease compared to other cities. And of course, the actual amount will depend on those numbers that come in.
I also wanted to add that we're very driven by tourism. So our population may be flat, but if our tourism is increasing, that would also contribute to the growth of our revenues as well.
So it's not a horrible thing if our population growth is flat?
Not necessarily.
Okay, thank you.
Commissioner Carla, I would agree with Sonia, not necessarily.
Commissioner Stevens?
Yeah, Scott, thank you for answering my questions I had in advance throughout your presentation, so I don't need to go over that again. I've got an interesting challenge I'll pose to you all, and coming from a conservative accountant where one of the postulates of accounting is conservative, this is going to fly in the face. You have a lot of recurring revenues. Revenues seem to always be coming more favorable for you. You have a lot of recurring audits. There's always auto audits, and you always have pickups from that, and you indicate you don't like to include that. But I guess one of the things to think about when you do your sales, your revenue projections this year is whether you should be just a touch less conservative in looking at all those things. So I'm conflicted in saying that, but you're always way under. And the other thing is, particularly with the system conversion, I believe you've got a lag in revenue being reported. So Scott, I think on one of your slides, you said you were quite favorable to budget already, and there's probably unrecorded revenue because of the system conversion, since you're only recording the, so the cash is all recorded, but there could be some other pickups.
Do you want to address that, Sonia?
I will. Yes, thank you, Commissioner Stevens. We will start to look at, I don't want to use the word less conservative because our philosophy and policy is that we will be conservative with our revenue projections. But you have to keep in mind that the last 5 years was anything but normal. That was unprecedented growth. I think it would be hard for the commission to accept us projecting a 20% increase in sales tax revenues. If we brought to you a 20% increase or even an 11% increase, you probably would say, put that number down. So we have had a very unprecedented, unusual last 5 years, and now we're looking at some reduction and flatness. So it's hard, it's a very difficult projection to make because it hasn't been a normal, consistent trend. So prior to the pandemic, if you look at the last 5 years, last 10 years, last 20 years, we could say that our average growth has been 4.5%. If you look at those time periods, going from maybe -2% to maybe 8%, but not 20%, 11%. And so it's just been very difficult for us to project. We also have not been including sales tax audit recoveries. We have always, I think in the past, recovered about $2 to $3 million in sales tax recoveries, but we have expanded our sales tax audit department a little bit, and we're now seeing some spikes in that. So we're considering maybe we should, because when it used to be $2 to $3 million, we just did not include it, but now it's $6 to $9 million potentially in some years. So we're looking at maybe including those in our projections that will help bump that up. We hope that soon that our sales tax revenues will go back to a more normal trend line. We just don't feel that we have a normal trend line to be able to project off of. So it's been very difficult. But we welcome the commissioner's recommendations. We will provide for you our new fiscal year 27 and 5-year projections in March. And so we welcome any suggestions that you might have. If you feel that we should bump that up or, whatever it is, we welcome that. Thank you.
Mr. Vice Chair, may I respond to something, Commissioner Stevens? You mentioned about system conversion. The vast majority of what we talked about in this presentation are not impacted by that. Mainly, we saw that through court fees and fines and also through franchise fees. So our sales tax, for example, collections has not been impacted by system conversion.
It's just when we went through the budget to actual stuff, there were several references throughout there talking about things not being recorded because of delays in system conversion. You're just saying that these revenues aren't part of that?
Correct. I am saying that. That's true.
Okay.
Schuyler, you had a comment, I believe?
I do. Can you guys hear me okay?
Yes.
Just a quick clarifying question about the transient occupancy tax, given the variance of 18%. Is this something that we've experienced before? And are we confident that we're going to get close to hitting our budget number? And if not, maybe we should all buy more Powerball tickets, make up for that decrease.
Mr. Vice Chair, Commissioner Badenoch, I don't know that I can speak with confidence that we will meet our budget number for the current year. We're, as it says, 18% lower than budget. We'll continue to monitor, and it's possible things will turn around in the upcoming months. If not, we'll adjust our projections accordingly.
But have we been there previously? Has that
Commissioner Badenoch, it's possible that we've been here in the past where 4 months into the fiscal year, we're below budget. I would have to research that and get back to you.
I mean, let me add to that. I think the transient occupancy tax, which is our 5% bed tax that's charged to hotels and motel operators, it's a lot more volatile because it is based on tourism and also hotel room prices and room availabilities. So there is more volatility in these numbers. We are considering if we should look to some industry experts that have more data in terms of visitor data and trend data that can assist us to better project these revenue streams.
And we've all seen the articles about the downturn in visits from Canada and from Europe and other countries coming here, and that directly affects our hotel occupancy. So, you know, some of this may play out over a few years, but I think that's a very good point.
Correct me if I'm wrong, though. Like on the budget to actual, I thought on page 14 and 15, you were short in revenue and you just shorted the destination marketing funding that's being done. So isn't there less sensitivity to this particular tax being under because you would then reduce the funding? So it's not quite as catastrophic? Okay.
Carl, I was trying to be politically correct. Skylar?
No, I was there an answer there?
Oh.
He didn't hear whether or not the answer to my statement was correct or not, that on the transient occupancy tax, if there's a shortfall there, there's a commensurate reduction in the funding you do for destination marketing, so it's less of a budget concern than maybe some other revenue projections would be. He wanted to know if that was a true statement.
Yeah, I think the way we would respond to that is in our special revenue funds, all of our special revenue funds, there is more ability for us to reduce expenditures because they're mostly, not all of them, some of them are not core services, and it's easier for us to, and I can let City Manager Caton comment on that, but there is more ability to do that, and we always work to align our budget to our expenditures. We would make mid-year budget adjustments if necessary.
Just add to the conversation of the 5% tax here, the 45% that goes to a vendor experience, Scottsdale is paid off actuals, is my understanding. Just paid on actuals.
Thank you for explaining that.
Thank you. If there's no more questions, I think we'll move on to the next segment, which is the...
Actually, he's not.
Sorry.
Yes, in the packet in front of you, we've spent much of our time tonight talking about taxes. Oh, can we go back to the pie chart that was on, I believe, slide 2 or 3 of the presentation? So we spent the majority of our time this evening talking about the blue, orange, and green wedges of that pie chart. And we have in the packet in front of you the all revenues for fiscal year 25-26, along with a 5-year history. That we gave you 5 years because that 10 years would just be way too large. And we get down to the line item detail level here. So we will go to, let's see, if you would go to page 5, we get past our tax revenues to our non-tax revenues. And we'll just take a look at some of the big picture trends. So building permit fees and charges, if you want to compare to your cheat sheet, those are in the general fund column in the pink fees and charges. So these are what are encompassing that category here. So looking at building permit fees and charges for the general fund, we increased from 17 million in fiscal year 21 to we're projecting $23.8 million in the current fiscal year. Looking at the next category, which, oh, okay. Yeah, we're still on page 5 of this packet. So under general fund, in that first column, under license, permits, and fees, you see that's not a massive driver, but we have the individual line items there, business licenses, liquor licenses, and things of that nature. When you add them all together, it comes up to about, in the fiscal year 25-26 adopted, $5.7 million, all of those together. Next category is charges for service / other for the general fund. The biggest driver in this category, we're now turning on to page 6. And about 7 lines down, you start to see Westworld rental facilities. A lot of the driver of this category is Westworld, various revenues that come in at Westworld. And then about halfway down, there's a fairly large revenue source for Tournament Players Club. We have stormwater fee, which is about $962,000 in fiscal year 25-26. And those are some of the biggest drivers of this category. And then if you, and Parks and Recreation, thank you for that. Parks and Recreation charges for service. We get up to the total for this category of about $20 million for fiscal year 25-26. I'm on page 7. Next category is fines, fees, and forfeitures. Here we have a lot of court-type fines and fees. We have photo enforcement kind of encompassed in this category here as well. If you go to the bottom, towards the bottom of page 7, the fines, fees, and forfeitures category generates about $7 million for the general fund. Intergovernmental for the general fund, it's just one line item there, just about $1.5 million, and that is the yellow portion on your cheat sheet, general fund, first column, down to intergovernmental. And we have in that number school resource officers and the Salt River Pima Crime Lab Service in that line. Going on to page 8, interest earnings is fairly significant. We're projecting about $11 million in fiscal year 25-26. Indirect cost, where we charge our enterprise funds for the indirect costs, is about $9.2 million. And then our other revenue on page 8. Okay. The other revenue is a very small portion of our revenues. Next, we've got ambulance. We're projecting about $7.7 million on the ambulance fund. Next fund is a transportation fund. Not any huge revenue amounts there, except when we get down to interest earnings on page 9, about $2.6 million to our transportation fund for interest earnings. Tourism fund, the largest driver, about halfway down through page 9, is the Scottsdale Princess lease revenue category, $3.6 million overall for charges for service. I'll move on to the special programs fund towards the bottom of 9. The stormwater fee for the CIP is fairly significant, just under $8 million. And then we see some McCormick-Stillman operating revenues there, charges for service. Turning to page 10, overall, the charges for service in the special programs fund, about $16 million. I'll skip the fines, fees, and forfeitures and the intergovernmental. And you get down to other revenue. A couple of the significant revenue drivers there, the smart and safe distribution, which is about 5 lines from the bottom. That is the taxation on marijuana, and opioid settlements, that's a couple of $1 million each. Stadium fund is contributions and donations. It's about $2 million a year for the whole category of charges for service. I'll move down to grants fund. So the grants fund total under grants, where it says grants 230 total, that's federal, overall federal state aid, about $6.7 million in fiscal year 25. That's kind of fallen from our fiscal year 2021, where it was at $16 million. So that's kind of changed over the years. That was kind of the high water mark of federal aid. The next is CDBG. That's a fairly significant grant that we have. Turning on to page 12. Housing Choice Voucher Program in our grants fund, that will be about $10 $10.8 million in fiscal year 25-26. Now we're getting into the enterprise funds on page 13. We'll just look at the water 600 total there. $146 million going into our water fund for the utilities and enterprises. That's user charges, service charges, and water usage charges. Water reclamation fund, about $62 million. Turning on to page 14, I think we'll probably skip through page 14, but there are other revenue sources listed there. We start getting into interest earnings. I think we'll probably skip through that as well. Going to page 16, solid waste fund. Under utilities and enterprises, this is listed at the very top of page 17, the total for solid waste fund. We anticipate $38 million in charges for solid waste. Most of those are residential charges to our residential users and also front load commercial customers. Aviation fund, about $9 million, bottom of page 17. And then we get into our internal service funds, which is on the second page of the cheat sheet there. And healthcare service fund on page 19. Our largest driver there is the benefits self-insurance total. About $41 million, almost all of that is contributions made by the city for healthcare contributions and employee contributions as well. Those are the biggest drivers of that 41 million. Fleet management, there was a question, the fleet management fund used to be one singular fund and then it was split into two. So that's why you see the fleet management total halfway down page 19 go from almost 30 million down to 16.5 because we created the fleet replacement fund at the bottom. So you see a fairly big revenue in the fleet replacement fund in fiscal year 25-26. Going to the last page, almost done, I promise. Risk management fund. The biggest driver of revenues into the risk management fund are charges for workman's comp, and that went from 11 million in fiscal year 21 down up to 20 million in the current fiscal year. Covered a lot in this packet, but I'm happy to address any questions that you may have now or in the future about any of these individual revenue sources.
So basically what we wanted to share with you is sort of our line item details for these revenues. When we project revenues for the budget, we do project every single line item, as you can see. We do work with each of the departments. And so if you look at the pie chart, we have, the fees and charges is a very significant piece of our revenues, but that's primarily driven by the fees and charges in the general fund and also in our water sewer fund. Aside from that, the rest of the fees and charges are not the lion's share of our fees and charges. And so we do work with the departments to develop those revenue projections. But we wanted to share these with you to let you see what those revenues are made up of.
Thank you. Commissioner Carla?
Yes, hopefully just one real quick question. Most of these, as you go through the actuals to the adopted, there's not great variances, and they all make sense, except when you go on page 15 and you go to your water reclamation 603, and you go to, you're dropping from 623 to 40,000, and I'm just curious why. Because
Which line item are you looking at?
It's page,
Water reclamation.
page 15, water reclamation, like 3/4 of the way down the bottom, and it says water reclamation 603 total, and the adopted budget has dropped all the way down to 40,000, and I'm just curious why, from like 623,000. And because everything else here, in the entire thing, it's all pretty even, and there's not giant variances. But this is a big variance, and I'm just curious why.
Okay, we will have to look into that and get back to you on that. I don't have the answer right now.
Thank you.
Thank you. Commissioner Stevens.
Okay, folks, I'm gonna make a big observation of what we're doing here. My understanding is we are only allowed to talk with each other and brainstorm to come up with ideas while we're in these meetings in front of the public. So we're limited to that as far as our forum. Today, we've probably spent well over 70% of our time, maybe 85% of our time, listening to presentations of materials we received in advance that we read in advance. We've come up with a few good ideas today of suggestions on different funding and maybe interest expense and use of reserves. But frankly, we haven't had a chance to talk to each other. And we're charged with being a budget review commission that's supposed to come up with recommendations to council. And the way we're going down this right now, I don't see a forum here where we get to talk to each other and come up with some recommendations that are meaningful. So part of this is probably necessary to get the new members up to speed on how things work, so I'm not being critical on that. I'm just making an observation, folks, that I think if we can't talk and brainstorm with each other, we're not going to come up with anything that's going to be that helpful. And also, going over stuff like this first time in a meeting is kind of hard to do. I came with my questions, and I had plenty, and it would be better if we just saw all the material in advance and came with questions and had more time to answer our questions and talk and brainstorm than just kind of being fed information. So I don't know where to go with that. But we're already, we're out of time. We're already at your time where we're supposed to be done with this section and go on to the next one, and we haven't talked about anything. So I guess my recommendation is going to be that we either think about trying to have less presentation time so the commissioners can talk more, or if you want to go over stuff like this with us, let us come down to the office, go through some of it, get our head up to speed so we're better prepared when we come here and we can use the valuable time here to actually brainstorm with each other. So. And if I'm wrong and you guys are all happy with what you're doing, then just keep doing it this way. I will continue to do my prep. I will continue to provide staff my questions in advance so they have a heads up on that, and I will only be providing that to them, and they'll decide if they want to forward it to you all. I won't be directly communicating with you all anymore just to play it safe, and I respect that.
So we provided this because I think the commission had asked for a level of detail with, more than just a presentation. So this was our effort to provide that level of detail beyond just the presentation. To the extent that we were not able to provide this, our staff were pretty busy. We have a lot of work to do. We were literally finishing this last night. And, it would be nice if we were able to just push a button and out pops this report from the system, but the report doesn't pop out looking like this. There's quite a lot of work to do to put it in this format so that it can be easily understood by the commission. We can do it a different way if it would help you all have more time to, and we will do our best to provide this information in more advance, but this was, we understand that this was a tough work through in terms of the detail that we have to provide, but we do have to work through these details in an open meeting and not in offices, and so we do have to provide this information in open meeting. We do understand it's tough to go through this detail. We do expect, we don't expect you guys to be able to understand all of it, but we will welcome any kind of follow-up questions as you guys have the opportunity to look through it, and we're just helping you as best we can.
Commissioner Carla.
I respect what Mark's saying, but I found the presentation walkthrough, even though I read it all ahead of time, I found it very helpful. And I think for the public that's watching this, it is very helpful. And if they're going to understand what we're doing and what staff does, again, very helpful. If there is not enough, and from what I understood, we all got to ask our questions. So maybe we schedule less stuff on the agenda. So if Mark wants us to have more inter-commissioner discussions, we do that. Or is that what comes when we actually see the proposed budget? Because in my mind, that's when we're going to want to have discussions. So that's just my 2 cents.
And I'm not opposed to having some time carved out after a presentation after the questions are over for some little discussion between us. We'll see if we can work that into the time frame, because Mark, I tend to agree with you that it's good to have that back and forth some. I also agree with Carla, when we see the budget is when we'll really want to have those discussions.
Okay, let's go ahead and go down that path, but I'll tell you, I do not like being unprepared for things. I like being prepared, so I'm ready and I know what's going to happen. And if you're telling me I can't have something like this in advance, I don't want to see it in a meeting. Find some other way to have us do what we're going to do. I would have rather had whatever you're going to talk about or present to us, I'd rather not get it cold in a meeting because it's only going to be hard to get my head around. And I'd rather have those things in advance. And I would like to have more time to talk with the commissioners on this, so.
Well,
Commissioner Newman?
just one point, they said that they were working on it just last night, so probably didn't have enough time to get that piece of the detail out. But I mean, we have two pretty meaty reports here. We haven't gotten to the monthly financial depth there, which I think we're kind of out of time, but I would like, to me, the report that we had at the beginning, we went through in terms of the financial conditions, I think that's appropriate level. I think the monthly financial report, I've read through that. I spent time yesterday and today reading through that. So that's the appropriate level. I was able to glean out the 4 or 5 things that we're going to focus on, at least in my mind. Now, Matt, to me, that's the level of discussion here. I think the accounting level of discussion, you got to trust staff to be able to go through that based on those broader directions that we have. And I think that's where as a practical matter, I think that's all we're going to be able to get to unless we have just meeting after meeting after meeting, week by week. So that's my view of that. I feel like we've gotten to a level of that captured what I was looking for in terms of metrics as a board level type of discussion.
The most meaningful thing that I was looking forward to today was going over the monthly financial budget to actuals. I found that to be the most helpful, insightful, and most prone to come up with ideas, and we got 13 minutes to go over it. So anyway, I guess my request is consider making the presentations more concise. Assume we did our prep and we read them, and try to give us more of a high-level presentation so that we have more time to talk about things. And maybe it will be more relevant once you get us the new budget information.
So we have 15 minutes left. Why don't we spend time on the monthly financial report?
Yes, let's go on to that right now.
Okay, you should have the quarterly financial report. These reflect figures through September of 2025. I'll start going through pages, and if there's areas that you'd like to focus on.
I'd like to stop. Can we just ask questions now? Did you all have a chance to look at this? I'd rather start with questions about this, and then if you think we're missing something, then go over a couple of those things that are important. And one of the things I know I would like to see is the fact that I would like to understand where you're at on the system conversion, because I saw scattered all throughout this document that revenue has been delayed in being recorded because of the conversion. I'm not sure if payables things are being slow and being recorded. So I'm interested in the quality of the information that we're looking at now, and there are a lot of timing differences in there. And I'll assume the timing differences are going to flush out later. And so is there anything you want to share about the system conversion? Because my assumption would be that revenue is understated.
No, I'm sorry. Then maybe that's a misunderstanding. I'm actually going to ask my Assistant City Treasurer, Anna Hanthorne, to speak to the conversion and how that has affected the recording of our revenue and expenditures. Anna, can you come speak with that?
Yes, so we had a system conversion changeover that started at the beginning of July. So some of the timing issues in the first quarter were a result of, there was a court entry that did not make it in until the following month. So there was a timing issue with some of the court revenues, as well as one of the property tax entries. It was a very small amount for the property tax because we get the large amounts in October, November timeframe. And then the only other one that we were reviewing is there was an issue with the franchise fees that comes from the water and sewer funds, and it goes over to the general fund. So those are some of the timing differences on the revenue. Related to the expenditures, we always have a little bit of a delay. The reason for that is we do accrual backs for most activity in July. They go back to June for those accruals. So I think the information that we saw with the expenditures is very normal. All of the invoice processing for the first quarter was in. We haven't seen a lot of any issues or delays from the system for that. We have a refined process between the budget and the accounting office now, where we'll make sure that everything is in on time. So we've really tightened up those processes. We don't anticipate to have these types of budget to actual differences related to any system change in the future.
I want to make one observation, though. The stuff you guys put out with the monthly analysis and your explanations is really, really, really good, and I rely on this a lot. I think it'll help us a lot. The only other thing, maybe if you can add, when you indicate something was a timing, if you could then also add what you think's going to happen the rest of the year. Like you said, this one, we're over $5 million because of advanced commodity purchases that we're timing. Well, it would have been nice if it's, and we think we're going to run over by a few million, or we think it's, will correct itself over the next 2 periods. If you did that, it would really just eliminate a whole bunch of questions. But this stuff is really good. You guys do a really good job on this and on the monthly ones you put out.
And I have one question, just procedurally, because I'm not sure. Mark, I agree that it would be handy if we assumed that we had all read this material and we could just ask questions. But how much of this for the public consumption, for people that are watching this, that don't have these documents? I mean, how much of that do we need to go through and make the presentation so that people who are watching it, and I think I'll turn that over to the city attorney.
I saw that look, so I assumed you wanted to ask me that question. Chair and members of the commission, it's really up to the Budget Commission. I think it is helpful to have the presentation so the public is fully informed. The main thing the commission has to worry about is proper agenda and having the public have an opportunity to hear what's going on. I assume the public has access to the materials as well through the webpage in advance, so they can also review those. So it's really a commission decision on how extensive you want the presentations to be.
Commissioner Carla.
Well, I have a question, because obviously we can't go through the same walkthrough on this and also do future agenda items and get out in our 2 hours, because there's 8 minutes left. So my question is, could we just bump this to the next agenda item and do an abbreviated like 10 minutes on this so the public will see something? And because it sounds like Mark is already asking his questions, which is, again, good questions, and then move on to the future agenda item presentation that we asked last time for Sonia to do.
So I'd like to make a suggestion. So our next meeting is in January, and we were planning on focusing on the capital improvement plan, and we will probably be working on our second quarter budget and actual at that time. So it might overlap, and it might be better to just wait a little longer. We can give you a report in March on the 2 quarters.
Sure, yes, that sounds good to me.
Commissioner Newman. Oh,
I agree with that. We're only 1 quarter in, and so the variances look small, but that also becomes a bump in the rug. And so the only question I had out of all of this was really more on some of the larger capital projects, things like that, because there was timing and some of the police and fire purchases were delayed. Right. To what degree is that just simply, oh, well, we know it's going to come, it just didn't come when we thought, because it's just a cash flow timing issue? Or how much of it is, hey, we're overestimating when the cash flow is going to happen, and then it doesn't happen and it gets delayed out? Or do we have a problem, or third, do we have a problem in getting it spent? And now we do have a real structural variance that is not going to get better.
So Commissioner Newman, as far as capital projects are concerned, they really are project by project. So every project has a different story. And for this report that you have, we currently do not have a capital project budget in actual. We will look at what reporting we can provide for that, but each project has a different story. So I can't generalize that way.
In this, I didn't see anything egregious, but I just saw that there was a lot of timing things in there. Is it small and it's kind of, okay, it's just data error, in the way things are happening in the first quarter, once you get 6 months in, but then 6 months in, it's getting almost too late to correct it if there's a problem. So I'm just trying to get a sense qualitatively, is there a problem anywhere that we've identified, or is it just more the way the numbers fell?
Okay, thank you for the question. The timing differences are very normal for us, especially in the first quarter. So we basically budget for the year, and we basically try to estimate how much will be spent or how much will be coming in each quarter, and that can be kind of tricky, as you can imagine, the amount of, the various and the complexity and the different types of revenues and expenditures that we have. And a lot of times we look at those projections based on the last year cash flow, which may not be anywhere close to this year's cash flow, but that's all we have to rely on sometimes, unless there was specific information provided by a department that they know when this is coming in or when this will be spent. It's very hard to, so we do expect those timing differences. We don't consider those timing differences to be a huge red flag, and we do monitor the budget and actual and the commitments that we have.
And all I would ask is that we flag if we have some kind of a structural problem or something that is abnormal, because it's hard to stick the landing at this granular level this early in the year. So, but if there's something there major going on that people need to know about, then I think that's worthwhile discussing. So
Yes,
that's all I'm
absolutely.
saying.
So our budget analysts do work with the departments to understand these budget to actual variances, and if it's just a timing issue, we're not usually worried about it, and we do try to find out if there's going to be a end of the year problem, if there's going to be a overall problem. We do that.
So, Mark, could I make a suggestion that, because we do need to move on, which is that we, going forward, we assume that all of the commissioners and all of the audience has looked at the materials in advance, and I don't want to completely cut out the presentations, but I would like abbreviated presentations, so then we can get into asking the questions that everybody has. Great. Is that agreeable to everyone?
That's also consistent with council, where you can go online and look at everything that they're in consent agenda and everything. You can look at that, and it's up to the public to do that, because we can't spend all of our time here educating the public. That's not the job here.
If that's agreeable, I think we would like to do that moving forward. And speaking of moving...
I got to do one more thing. I know I seem real frustrated, and I wear my emotions on my sleeve sometime. You all need to know how much respect I have for you, how good I think you people are, and I hope you don't take anything negative out of my frustration in what I just said. You've got some wonderful people on your staff here, and we rely on you, and I want you all to stay here.
Noted. And with that, we're going to go on to the items to be presented at upcoming meetings.
Can you pull up the slide? So this was requested by the commission to give you guys an idea of what we will be providing at the next meeting. The next meeting in January 22nd will be focused on the capital improvement plan. We are working towards reviewing those submissions from the departments. The city manager's office and his capital project review team has been working all year on this. And so we hope to be able to bring to you, next slide, please. Last year, we brought to you a book that is over 100 pages long with every single project, listing all projects by program with the project name, description, location, project cost, 5-year cost, and funding sources. We will have something similar. Now, last year's budget book was produced from our old system, and this year's book will be produced from our new system. So we're still working with our vendor to identify how we lay this out. So it's not going to look anything like last year, but it will provide the same information. Next slide. We are also planning on providing these lists to you, the list of capital projects this year with budget increases over 10% and 1 million. That is part of our policy that we will go to council specifically and explain those to council. I think there are very few projects that we are aware of this year, if any at all, that do meet that criteria, but you will get a list of that. We will have a summary showing the fiscal year proposed 26-27 5-year capital improvement plan with the carry forwards that we anticipate, the new requests, and the new proposed 5-year. And of the new requests, we will break that down to show you a list of new requests for new projects versus a list of new requests for changes to existing projects. And we will also provide a list of, if there's any projects that are eliminated from the 5-year CIP. We may not have eliminated the project, but we may have removed the construction costs and left the design costs because we don't know the construction costs yet, but we will share those with you. and then a list of completed projects. So if projects are completed and they're no longer needing to be carried forward, we will provide that to you as well. So we're striving to provide all this information to you. The new system, we're unsure of what type of reports can be generated to provide this, so there will be some manual work in order to provide that to you.
Thank you. Yeah, I like that. I like that. So
Could I just ask
Sure,
a
Randy.
question? And this is just going back to doing a presentation of the budget, of the quarterly report. And so so what I would be looking for as an overview would be any discrepancies that you noticed in the budget that any adjustments you're going to make to the budget based on information you now have. To me, that would seem to be the most significant information to get. Yeah.
Yes, thank you for that comment, Commissioner Pullen. With the first quarter, it's really hard to tell.
Yes.
Because a lot of times there may be budget savings that offset if we have a certain category of line item that is over budget, a lot of times we anticipate savings to offset that, and they end the year still within budget. And so for the first quarter, it's really hard for us to know. There may be specific things that we do know. So if we do know specifically that we will go over budget and we do need a budget adjustment, we will bring that to you. But first quarter is hard to tell. Even the second quarter might be hard to tell, but by the third quarter, we will know these items will require budget adjustments, and here's the reasons why.
Thank you. So now let's go on to identification and approval of possible future agenda items. Is there anything, Commissioner Carla?
Yes, I have, in addition to the answer on that water variance, last budget cycle, we talked about how the human services budget, particularly at Paiute Neighborhood Center, which helps low-income families and especially seniors, was going to be impacted by all of the federal cuts in that area. And I would like to hear specifically, how is it impacting it, and how is the city making up for it so these families and seniors aren't, just left adrift? Specifically, for seniors, the LIHEAP program, which helps immensely with utility costs. And I know, for a fact that has been cut dramatically. So my question is, if we can get an update on that, that would be greatly appreciated. Thank you.
Does
If
anyone else have any?
everybody's open to it.
Does anyone, no? Okay. So if there's no other comments on that, I move we.
Wait, I drew a blank. I thought I had something I wanted in there, and I drew a blank. I'm sorry about that. Let me ask a quick question, though. But if I want to look at a cost estimate on one of these contracts that we've got, is that something I can do in advance so I can see what's out of an estimation system, what's out of a certain type of contract, or whatever the cost buildup is on one? Or is that going to have to be done here, so it's just not possible?
You could do it in advance as long as they can provide it to you in advance.
Okay, I might make a couple of suggestions I want to look at, and if it makes sense, you'll figure out how we're going to do that. Oh, I know what I wanted to ask. Let me know if this is possible, and if it's not, we won't do it. Do you do a reserve roll forward for fund balance and reserves, and would it be possible to see something like that for the first 6 months of the year so we can see the reserve and fund balance changes? Or is that not what, if that's not something you do, or is that something pretty? You know what, let's not make that a future agenda item. Why don't you all kind of look at that to see what would be involved in doing that and make a judgment about whether that would be of value? Okay, so no future agenda item on that.
And Chair, members of the commission, technically, as you bring up future agenda items, you're supposed to come to a conclusion or decision whether to agendize it for in the future. And you have three options. You can either agendize it for discussion, ask for a report or a presentation, but you're supposed to vote on it. So for example, Commissioner Carla's suggestion, the commission needs to vote whether to agendize it, give or ask for a report on it, or take no action.
Commissioner Carla.
I mean, I'm good with, a report to us on it unless there's huge deficits. And then I would like to have it discussed as to how the city's going to make it up, so these families aren't just thrown off a cliff. That's my opinion, but again, the group has to decide.
I'll second it. Aye.
Aye.
Okay.
Okay,
Motion
and then
carries.
I want to propose a future agenda item at the sole discretion of the treasurer with respect to including a fund balance and reserve roll forward if it is easily prepared.
Is there a second for that motion? I'll second the motion. Any further discuss, Commissioner Newman?
What additional information does that give us than we already have?
Right now, that's one of the biggest things that's kind of hidden in there. It'll tell you how much money might be available for PSRS, additional advanced funding. You can see if what kind of surpluses are building up in the reserve and fund balance area. You can see if there's been any reallocations or reserves. So it's kind of a separate little kitty that lets you know what might be available. And then you can make judgment about, do I do advanced funding on PSRS or do I need that for roads or whatever else it is?
So what action would the Budget Commission take on that information?
Once you know that, you then know whether or not you want to make recommendations about doing more, improve the PCI quicker, about do more advanced funding for the retirement plans, or make any other budget changes that would impact police salaries. Well, no, that'd be bad. That'd be recurring. It would just be, it would tell you what's available for future budget adjustments as things are presented to us.
And I believe last year we did look at that kind of information, and that's what
Right.
helped us come up with the recommendation to make a $50 million pay down of the pension funds.
Yeah.
I have no further comment. So
Okay.
I just have trouble seeing how, as a practical matter, that's going to make a big difference in what we're doing. But I'll defer to the group on that. I'm not there.
So a motion's been made and seconded. Any further discussion? Otherwise, all those in favor, please say aye.
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 You better take a
Opposed?
hand count.
So we have 2 ayes, 1 nay, and 2 silences.
Well, can I just verify that the motion says that this is at the sole discretion of the
Yes.
treasurer?
Yes, it is at the sole discretion of the treasurer.
Then I will say aye.
Yeah, aye. Yeah.
Okay. Let the record show that after some discussion, it passed unanimously. Is there a motion to adjourn?
Motion adjourned.
Okay, meeting adjourned. We don't have to vote on that.